We saw Zoom, something that a lot of us use now and have. And Zoom beat by 20 cents. They reported, full year fiscal 2022 earnings percent above consensus, revenues above consensus, but it wasn't as high as people wanted. And they're looking at 2022 earnings, full year earnings at the consensus is around 480. And they provided between 475, 479, and which was expected as 466, but it's around 480. When you look at Capital IQ, the revenue is okay, but the stock got hit because they said they're not seeing enough growth in this name. And there's a lot of lessons to be learned here because one, I want to say that Zoom, Daniel, is one of the most amazing companies I've ever seen in terms of growth. And it took a catastrophic event for that to happen. And you wanted to show this, and I know you follow Zoom as well. I want to get your thoughts on this, but here is, and I have this on Capital IQ again. We do videos of everything on a Curzio Research YouTube page. I'm just showing you my Capital IQ page, which we do pay a lot of money for. But just if you look at the total revenue on an annual basis, in 2018 they were generating $151 million. They're going to generate $4 billion in 2022. And in 2021, it went to 2.6. It's going to the full year's 3.6. But you're talking about this little small company that went to massive growth. I mean, earnings are going to be, $4.80. That's $1.5 billion in net income, right? So you're looking at income. Net income was $7.6 million in 2018.
Jeez.
You know what I mean? So you're looking at in 2022, $1.4 billion in net income. So, you're looking at a company like this is pretty incredible to me, but it didn't meet estimates and the stock fell. And I know we were talking about it with Zoom and I said, listen, man, we got to look at these numbers and see the incredible. There's a lot of lessons to learn here and I'll go over those. But I want to get your thoughts on Zoom. Again, a stay-at-home stock, a company that was in the right industry at the right time. They took full advantage and, it has pulled back. Kathy Wood has used to pull back to add some shares. I forgot how many she added. But, that was a big story. And I think the stock's up a little bit today, but it fell like 16% after they reported earnings, which they beat earnings, but, everyone was expecting a little bit more than that.
Yeah, this is a perfect story of what we were talking about last week with it's difficult to buy as things continue to go up. Frank, if you have a chart, I think that in 2019, did the stock go up fourfold? I believe it went up 4 times. Now, again, we were just talking. It's very difficult to buy. We were talking about Dick's Sporting Good last week and saying, hey, it's probably a better buy now, even after the chart, looking at it, continually rise. It's hard to buy things that just keep going up in a straight line. But to your point, that company and their management team took advantage of a terrible situation on the COVID and the pull forward that they were getting as travel came to a cease and everybody was going online. But man, you talk about execution, because I remember seeing headlines about their Zoom calls getting hacked, Frank, and people were playing music or pornography or whatever they were doing to ruin these meetings. So what does Zoom do? They went out and they bought, cybersecurity companies, and they beefed up their security, and they were using their stock as currency. I believe that. I'm going off of a little bit of memory there, but you talk about just taking advantage of an excellent environment and rewarding. So if you're a naysayer, you can say, oh, well, the stock, I believe it hit 600 at one point or damn near. So it's down over 50%. So what if you bought
COVID
back then?
hit, you're looking at, at the end of, basically 2020, $66, and it went to, I think the highs were close to 600. 559, and then it got cut in half. And then you're looking into this quarter saying, okay, it's already been cut in half. The numbers, they met the numbers, they raised guidance, and it still got hit. Here's some of the lessons, guys, that I could teach you about this. One is you have to be aware when growth slows, and it's slower growth, even though they met expectations, you're going to see the stock get hit. Usually when the stock runs up higher, you're going to get hit more, but this stock has come down. I was surprised about the hit. Maybe that's why Kathy Wood's adding. But you're looking at a company that saw absolutely tremendous growth. More growth. I can't think of another company that saw growth like this in terms of those numbers. And then a percentage, if you could do $10 in revenue, do $25 million. And I'm talking about, billions, right? You look at this company going to generate $4.80 in earnings. It's trading around 300. And, when I look at that, I see a company that was super expensive. And if you're going to buy super expensive companies, you got to make sure that they continue to grow. Netflix continue to grow. Microsoft continue to grow. A lot of these companies continue to grow. You're seeing that with, CrowdStrike, who, pull back a little bit after earnings, just, Workday, whatever. Some of these companies continue to grow. They're fine. That's great. But when the growth slows, or you see that growth slowing, and, maybe this service isn't going to be used as much as more people. Again, we have the Delta variant, but more people are going to go to work. For me, when I look at this, it's why is it coming down so much? I mean, the thing has run up tremendously. So if you're running up close to 10-fold, 9-fold, you're going to, that growth happened right away. It didn't happen over 5 years. It happened in 2. So now you see the company come down. So then if you want to buy it on this pullback, which Kathy Wood did, I will look at where earnings are. So you're looking at earnings, and if you're looking at $300 stock price, and it's price divided by earnings, and those expected earnings for next year are $480, I believe. So you're looking at a company trading at what, 62 times forward earnings. Now, you could say the S&P 500, the S&P 500 trades at 21, 22 times forward earnings. So this stock is super expensive. I'm going to avoid it. However, you really want to look at how fast it's growing, because at 62 times forward earnings, that could be very cheap if you expect to grow earnings at 40% plus a year. And that's why I think people get lost in this. And I love what, BMR, a Big Money Report that, we hired Luke Downey, covers this stuff, right? Because these are stocks that you would avoid. And yet you might say, well, they're still going to see tremendous growth and how much they're growing. I don't know how much you're growing, right? So I'm going to go into Capital IQ right now, really quick, guys. I'm not going to go crazy here. They have Capital IQ estimates. And it'll show you based on the year of what they're expected. So you're looking for earnings to pretty much slow. 2021 and 2022, you have very, very strong earnings. But if you look at 480 in 2022, analysts are expecting 484 in 2023 and 519 in 2024. That's well below growth. So the 62 PE, growing earnings in the single digits from 22 to 2024, that's a company that I would personally avoid because I don't see that growth. If they blow out those numbers, then, hey, you know what? You're wrong. You're going to be able to get it, and it's a good price. But just because a company's trading at 50, 60, 70 times earnings, forward earnings, doesn't necessarily mean you could avoid it, because a lot of times those stocks you would have bought Apple, you'd probably be up 5,000% on Apple in the past 10 years if you bought it. And when you bought it, you would have had to buy that at 60 times plus forward earnings. So just to explain to you, if that growth is there, you'll see these companies continue to take off. Apple didn't go up tremendously right away like this and show, 9x, 10x returns in 2 years. But I think you guys could see the point where, Zoom got hit. I wouldn't be buying it right here on this pullback. Kathy Wood thinks otherwise. I think a lot of that growth, it's just in a 2-year span. We had, a black swan event. But when I look at Zoom, I think it's a relative story because you want to invest in growth. It is a growth market, Daniel. And in order to invest in growth, you have to understand you got to be buying expensive companies, but you have to continue to see that growth in order to maintain those gains and get those huge gains. And in Zoom, I don't know if those gains are there anymore. I think it's trading at a level where it could come down more. I could be wrong, but that's what I think.
Yeah, I mean, nobody knows the future here. However, it'll be interesting to see where it kind of hammers out on the chart, where it kind of finds a base or support. I would use this. This is going to be a good segue here, Frank, because I totally missed the move up. We just explained that about how it's hard to buy. I would trade if I had to, which you don't. That's the great thing about investing. You don't ever have to do anything. You can sit there, as Charlie Munger said of Warren Buffett. He sits on his ass and reads a lot. Frank, that's good advice. You can sit here and just watch this. I would trade it around the Delta variant if you think that that's going to have an impact. If you think that travel is going to not come back in a hard way or a big way, and that Zoom, is going to have some more pull forward or be able to, they don't have to grow as fast if you can increase your earnings once you capture that growth.